Hello, everyone. Welcome. Please take a seat. We're going to be talking about exit and secondaries. How do we relaunch impact investing in a market that is pretty dry, as you know, on the IPO front? My name is Helena Wasserman. I'm the founder of Unstoppable. We accelerate climate founders and climate professionals to go next level. So without further ado, I'd like to welcome my fellow panelists on stage. I'd like to welcome Alexandre Covello, managing partner of 109 Capital. They're focused on unlocking value in VCs through secondaries. You can take a seat here. The music was a little bit delayed, but we're here. Next to this, today we want to welcome Germain, who is with Bpifrance on the innovation team as an investment director on the Fund of Funds group. And finally, there is our dear Benjamin Joffe, who is partner of SOSV, who is a big VC that has done more than 200 climate investments in deep tech. So before, I know a few people have just left, but just before we jump in, we'd like to get a bit of an understanding about who's in the room. So first of all, who's your first time at ChangeNOW? Hands up. Ah, wow. Okay. Okay, so we're all newbies here. Awesome. Who's been here twice? Okay, maybe like 5% of the room. All right. So yeah, so very excited to be here. It's great to see so many people who give a damn. So thank you for caring and thank you for being here. And who in the room is an investor? Okay, cool. And who in the room is a VC investor? Okay, maybe 20 hands. Who is a private equity investor? 3 hands. An angel investor? 5 hands. Okay, cool. Who's a startup founder? Okay, 10 hands. Awesome. Wonderful. Well, as I said, we're going to talk about exit and secondaries. As you know, the IPO market has been pretty dry since 2021. Not much action has been happening, so we want to think about how do we relaunch the market. So without further ado, I'd love to hear just from all of you, just a quick 1 sentence about what you do. Alexandre, could you start us?
Yeah, sure thing. Very happy to be here. So I'm a managing partner at 109 Capital. We're a specialist venture capital secondary fund. We'll discuss later what secondaries are, but we focus on buying portfolios from GPs or LPs.
Anne?
Hello, everybody. I'm Germain. I work with Bpifrance. We're the French state organization that basically provides financial services and solutions to small and medium-sized enterprises and startups. I work more specifically in the Fund of Funds department in innovation. Thank you.
Benjamin?
Sorry. Hi, everyone. My name is Ben Joffe. I'm a partner at SOSV. We invest in early-stage deep tech startups. We typically the first check in companies that have just a founding team on the early prototype, and we back about 80 new startups every year in climate and health tech all around the world.
Thank you. So we're going to talk about exit and secondaries, and we're going to focus on technology and in climate tech specifically today for the purpose of this discussion. But before we jump into these technologies, we want to first find out, why are we even talking about this? Why do exit and secondaries even matter? And what does a healthy climate tech ecosystem look like? Benjamin, would love to hear your insight on that.
Yeah, so what's interesting, I think, in investment is that exits sort of condition what comes at the beginning. And if nobody believes there can be an exit for the startups to invest in early on, then you just don't find the money to invest it unless you have that money yourself. So as a deep tech fund, we have to show that we see a hope for all the companies we back in many sectors that are not proven yet. There might be very clear demand. When you deal with deep tech, generally you deal with big problems. You deal with energy, you deal with food, you deal with industry. But so far, you mentioned the IPO market, many exits, the vast majority of exits, actually M&As, and there just hasn't been that many deep tech M&As in impact sectors. So if you look at the ecosystem, it becomes very important to see more and more exits of larger and larger sizes so that early stage funds and then the growth funds and all the capital stack you need on the way find the capital to actually deploy. So that's my take on the ecosystem.
Thank you, Benjamin. Anne and Alexandre, do you have anything to add?
Well, yes, absolutely. If you don't have exits, you're not going to have investors. So ability to show liquidity is absolutely essential. Otherwise, the impact sector is just never really going to scale.
Right. So now we've covered, why does that even matter? And, obviously, climate tech is a new sector, right? Most companies in climate have been around not even 5 years. We've had a first wave of clean tech more than a decade ago that, as you may remember, didn't go so well. And this is a second wave that we've rebranded. Instead of clean tech, we've rebranded it climate tech, but essentially it is the same thing. And so because it's such a young sector, what can we learn from technology companies that have been around for more than 20 years, that have gone through several cycles? So I'd love to hear a little bit from you, Alexandre. What can we learn from technology that can be applied to climate tech?
Absolutely. So just to piggyback on what has just been said, I think we all agree that we have a liquidity problem, and we have a liquidity problem at different levels. And when I say we, is us practitioners in the room, so VCs and impact VCs, but also private equity managers, public equity managers. So I think the relationship between tech and VC in general, and impact specifically, is that as of today in 2024, we have a main problem, which is we need to provide liquidity to the ecosystem, as I was saying before, at different levels, for employees, for founders, at company level. We need to provide liquidity to LPs. We also need to provide liquidity to GPs for them to be able to distribute more cash to their LPs and DPI. So I think now the parallel between tech and impact is that although impact is a younger market, we are at the same stage.
Mm-hmm. Does anybody have something else to add on that note in terms of what can we learn from technology, exits, and liquidity in that market that can be applied to climate?
I think things have changed a lot, actually, for the past 20 years, because at the time, it was really concentrated around very specific things, around energy production with solar and wind, EVs and batteries associated. So it was pretty narrow in the whole kind of impact landscape. And today, it's really everywhere. When you think about climate tech, I mean, it's energy, it's food, it's industry, it's transportation, it's of course all the nature-based solutions, all kinds of things. So it really touches almost everybody. There's now also huge changes in the perception of governments, perception of people. So earlier you asked the audience if people were investors or startup founders. I'd like to ask another question. So who works in a startup with a company with impact? So, okay, who would like to work in a company with impact? If not yet, okay. So you see, I think there's a big shift that's happening also in the market in terms of where the talent is going. And the talent wants to go to impact companies, but if you can't fund them, finance them, they can't hire people. And I think the earlier session there was discussion about Nobel Prizes, so we were discussing earlier that Nobel Prizes are very great, but they're a very big lagging indicator of innovation, because it's after decades of research that finally you get a Nobel Prize when you're basically about to retire sometimes, right? or past retirement. And that's a problem, because if you need that validation to start a company, for instance, to apply that research, then it's very late. And in the case of startups, you also can't wait for exits to happen in your sector to validate what you're doing. You have to believe that it's going to work. And it's not just for crazy ideas, but I recall a conversation in the US with one of the founders of a company called Form Energy. They do long duration energy storage. It's really important on the grid to store intermittent energy like solar and wind. And the team's fantastic, from MIT, like super well-known professor. One guy used to work at Tesla for I don't know how long. And the team's fantastic, but even then, when they started, they just had a hard time finding the first round of funding, and they were not sure there would be anybody to follow on. And when I talked to the founder, he said, oh, well, luckily, the market has changed in about 4 or 5 years, and now it's fantastic, and that company is a multi-billion-dollar valuation company. So there's all this problem of kind of having some kind of belief that it's going to work, and it's going to be not only useful innovation, but there's going to be some path to liquidity at some point.
And I think another thing that's evolved is ESG, and how a lot of institutional investors have now integrated that in part of their investment decision, which is an opportunity, but also a risk for a number of startups and companies. And by risk, I'm referring to potential for greenwashing, of course.
Thank you. Alexandre, anything you'd like to add? Any disagreements?
No, I agree. Maybe a few examples again on very quickly. If we take the three levels of three levels where you can provide liquidity in private equity, venture capital, and impact. So the first one is LP stakes. There was a recent transaction between Blue Earth and British Intelligence Initiative, where Blue Earth bought 3 funds from BEI. The main positive thing of that is that Blue Earth buying those LP stakes brought more liquidity in the system and enabled people to reinvest. So that you see how that can apply at LP stake. It also works at portfolio level. In Europe, we don't have as many organized, structured secondary funds focused on impact as of yet, but there are a few in the US. One of them is North Sky. North Sky completed a transaction last year where they bought a 100 million portfolio from Total Energy, and which they gave and they passed to a new GP for hire, as we say in our jargon, so a new manager to manage those assets. And the last thing that I'll say, I'm a former VC as well, I've invested in more than 200 companies over the last decade, is that the big difference that I see in secondaries and impact, to answer your first question, Helena, is that when you invest into tech or into software, the key issue is about finding product market fit. And that product market fit, it's always difficult to find. I think that with impact, especially in climate or other, in whatever sector, product market fit is there. If you're replacing traditional cars with EVs, you know that people will continue to use cars. There may be other ways of transportation, but the car will still be there. So you don't have that product market fit issue. So from a secondary perspective, coming in late, or 5 or 6, 7 years after that investment has been made, you can also prove that the technological part has been achieved. So it's a better way maybe to enter into the market.
Yeah, if I may, actually, I think there's multiple aspects of product market fit. I mean, there's a technology aspect, but there's also, and that's really important for scaling, is do the unit economics work? And that's something you can verify pretty early on with a SaaS company. But with a technology company, sometimes it takes a long time. So to give one example, in our portfolio, we have a company that's working on a cultured protein, a company called Upside Foods, one of the pioneers in basically cultured chicken, beef, and other things. And I mean, first they had to prove the science could work, and they did that. But now they have to prove that they can basically make a steak or a filet cheaper and tastier than what's on market. And for that, it's not just one technological innovation. It's also the ability to scale the bioreactors that they use, that it's a new format because it's not the same that for pharma or beer. They need to find also the growth media in a way that is not using like FBS, if some of you know what that is. It's not particularly clean or environmentally friendly growth media. So they need to have a sequence of innovations, and then they need to be able to deploy at scale, in an industrial scale. And that's what really unlocks the large tickets. When basically you have predictable revenue and profit, that's really what unlocks the big amounts of capital. And I think for a lot of climate tech, we're not there yet. And Upside Foods has been around for about 8 years now. They have built a pilot facility, and they're getting closer to the economics needed to basically build many factories, but in that particular sector, it's not there yet, and I think it's similar in many other sectors in climate tech.
It's interesting to talk about cultivated meat. I was actually one of the first 200 people to try cultivated chicken in Singapore 2 years ago, when it wasn't legal yet in many parts of the world.
Illegal tasting.
And I'm still alive. And it actually tasted like chicken nuggets, so it was perfectly fine taste-wise. But as Benjamin said, in terms of having proper replicability, price that really makes sense in the market is a different story and takes way longer. So on that front, as we were talking about, the IPO market is pretty dry. Not much has been happened since 2021. I mean, I think in climate tech in 2023 we had 2 IPOs. So obviously, we need more movement. But most of you in the room are entrepreneurs, so we're not going to wait for IPOs to happen. So what can we do? Can we just deep dive a little more in what can we do to activate the markets, whether it's M&A acquisitions, private equity investments, what can be done from an investor and entrepreneur perspective? Maybe
I'll take this one. So you mentioned IPO, which is always the growl for a lot of entrepreneurs who, very ambitious entrepreneurs, won't worry about the issues in Europe more particularly, but a lot of work is being done at all bunch of different levels of government and in the European Union to have a more liquid market in general. Obviously, most exits are via M&A, corporate acquisitions, and again, a lot of European corporates do struggle a bit with acquiring startups and integrating them while keeping the value, although it probably happens in some sectors more than others. I'm thinking financial sector in general, but also in life sciences. Clearly, we got a very good example of that recently with the acquisition of Amolyt by AstraZeneca for €1 billion, what was announced, I think, last week. So you do have those great stories, but they tend to be maybe more focused on specific areas. Another big initiative that's been taking place in France, but also at the European level, has been the development of growth funds. I think everybody knows that most companies now stay private for a lot longer than they used to be. Again, speaking about IPOs and in general, I don't know the statistics, but effectively you've got a lot less companies that are actually listed nowadays than 20 years ago. Ergo, you've got a lot more private companies. And so how to keep on financing those companies until they reach that scale? Well, you need further funds, growth funds, and that can be also an opportunity for liquidity for the earlier stage funds, or at least for partial liquidity when they exit. And finally, and maybe a more creatively, so those could be considered secondaries, an acquisition by a growth fund or a buyout fund. And finally, we've got what we call GP-led secondaries, where somebody would acquire part of a portfolio, providing liquidity to the existing fund or the LPs of those funds. Again, providing that liquidity and allowing other investors who are keen to get in. Those are some of the different options that exist.
Great. So to boost the market, aside from IPOs, we have GP-led secondaries and obviously private equity investing. Do you have any examples to kind of bring those types of boosts to life, to the audience, of things, maybe deals you've worked on? You work for the French Sovereign Wealth Fund. You must have a lot of interesting insights on the market.
Yep. Listen, GP-led secondaries tend to be rather confidential transactions, so I can't really comment on that. However, on the growth side of things, an example recently has been the acquisition of Vade Secure by Hornet Security, so creating sort of a European champion in the cybersecurity space, and Hornet Security is actually supported by an American growth fund called Providence Strategic Growth, so that can be an example of that kind of sort of rolled-up operation that can provide some liquidity.
Wonderful. Alexandre?
Yeah, maybe one word on GP-led without without mentioning any names. It's an interesting model and technicality that appeared 10 years ago in secondaries. It's really applied in private equity, for the time being less so in venture, because more often than not, managers don't want to trade their trophy assets and their fund returners, and then they get an issue with their talent portfolio. But if you think of it from an impact investing perspective, what you see is that as an LP or as a secondary fund or as an institutional investor, backing a GP-led transaction, so basically giving new money to a managing, passing their best assets into one vehicle, into a continuation vehicle, gives you access to impact assets or climate assets immediately. So if you're an institutional investor trying to deploy, you have to go through the cycle of investing with funds, and so you need, by doing those GP-led transactions, you can get to best assets more quickly. The other thing, from another technical perspective, if you think about Article 8 and Article 9 of SFRD, it's also a way to take some assets that may not have not qualified in their existing funds, and while you pass them into the continuation vehicle, ask for those Article 9 requirements to be applied.
Benjamin, anything you'd like to share? Disagreement stories?
Yeah, like just something came to mind that was more relevant 2 years ago. There was a one-word SoftBank that was great for liquidity for late-stage investors. But I think I'd like to look at something a bit beyond that. Is why do we need liquidity along the way? It's also partly because, as was mentioned earlier, there's not enough M&As. And the reason there's not enough M&As is because in impact tech, climate, health, and others, large corporates don't have enough experience buying and integrating deep tech assets. And that's really a problem. Like a few years ago, I ran a series of workshops about, it was basically an M&A masterclass for people in M&As, and particularly in deep tech. And I just couldn't even find people with more than 10 deals, 10 acquisition deals in deep tech in Europe was really hard to find. Whereas when I did the same show in San Francisco, I got John Chambers from Cisco, and he had done during his 20 years tenure 180 M&As. And that was an integral part of his strategy. And I remember a few things he said that I think is probably interesting for other corporates, is that they tried to establish very early on a playbook on how to do successful M&As. And I think that's what's missing in many corporates, is they don't have this vision of a playbook. They don't learn by doing. And in his case, he had a particular playbook that maybe doesn't apply to everybody, but he was saying, I only buy companies that have a good cultural fit, because I don't know how to integrate people with vastly different culture. And it was also planning the career for the people joining his company, because 180 M&As, you can imagine that at some point in time, maybe there was 100 CEOs working at Cisco. And those are a little bit particular people. You know, the reason they start companies, sometimes because they're kind of unemployable, they don't like to take orders, they do their own thing. And he had to figure out what kind of career he could offer them for them to stay in Cisco. So when they were approaching companies for acquisitions, he would come up with a kind of a draft press release, say, this is what we want to do. So we're buying a company for, like, I don't know, you're doing cybersecurity, we want to do that, and we want you to be the boss of that division. We want that to become a huge division. And so having this understanding on how to not only buy companies, but do that successfully, because many fail, and build a playbook that might be very particular to your industry, your sector, and maybe even this moment in time, I think really important. So and I want to also use that word of playbook for deep tech investors and impact investors, because we had to build our own playbook. When we started, we were doing mostly simpler stuff, and then gradually we realized, okay, well, we could try this harder stuff. It looks doable, but let's see. Like the first time we did a robotics deal, we're not quite sure we could actually handle that. The first time we did a medtech device deal, same. First time we did cultured meat deal, there was no cultured meat deal anywhere. There was not even the cultured meat word. So you need to learn how to build your own playbook, and there's some best practices probably we can share in some ways. But I think for the the endpoint for liquidity means it's going to be tied to, I think, corporates learning to do it.
And also having corporates with deep pockets.
That too.
And so, and that's also where maybe it's a bit more of a struggle in Europe, where we don't have the famous GAFAMs. But I'm counting on Novo Nordisk to be acquiring a bunch of life science companies. We'll see.
And LVMH could buy some biomaterials.
Very good point.
So we only have a few minutes left, but before this panel, I was briefed by the organizers, and they said, Helena, make sure every single panel must be about solutions. So I'm just going to recap the solutions that we talked about. So we have M&A acquisition playbook, number one. Looking at the US as example, because they obviously have way more experience and track record. We had GP-led transactions, and we had private equity deals as solutions to boost the market on top of IPOs who are hopefully coming back soon. Just to round up the conversation, I know we've touched on a few things, but if we think about just climate tech and what can be done specifically for that, anything else you'd like to add with your experience, Benjamin?
Yeah, I'd like to have some inspiring words, but I think instead I'm going to talk about that it's all about making actually things that look spectacular, become increasingly boring. And boring in terms of predictable, in terms of revenue, boring in terms of distribution, so that the money that loves predictable stuff, which is the biggest amount of capital you can imagine in the world, can actually apply to it. And that's my words.
I like that. I grew up thinking that boring was not cool, but now that I'm an investor, I also think boring is where it's at for scalability. Anne, any last words on the topic?
Well, I think really to Benjamin's point, and what's tricky right now is that I think the climate tech ecosystem is sort of itself a bit of a startup, and a lot of the speaking as a fund of funds investor, but a lot of funds are very emerging, and a lot of institutional investors are weary of that. So it's going beyond that hump, and again, showing that liquidity, even if it is a bit early or you want to take it a bit later, is important to attract that boring regular money, and to again scale the sector. So
takeaway: boring is the new cool. Alexandre.
Orange is the new black. No, I hope we managed in conveying that liquidity is coming. It may not come from where we expect it. It may not come directly to you as you need it today. It may not come in the form we want, but it will be there. We need that for every market. We need that for venture capital at large. We need that for impact climate. Liquidity is there, but probably not as we want it in 2024, but it will come at some point.
And last few words for me, I think I'm just very excited to see so many people who care and so many new kinds of investors in the room that are investing differently, that are smart business investors, but really care about nature and the planet. So on those last words, thank you so much, everyone, for attending. Thank you, Alexandre and Benjamin. Big round of applause.